Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, let's dive right into this explainer and unpack how three major logistics players are battling through what is arguably one of the most severe freight recessions in modern history. The less-than-truckload or LTL sector isn't just about moving boxes from point A to point B. It's a pure, unfiltered reflection of the industrial economy. And right now, these operators are staring down some incredible macroeconomic headwinds. We're going to bypass the noise, dig straight into the operational data, and uncover how survival in this brutal space has taken three wildly different paths. Here's our roadmap for today. We'll start with the macro headwinds of the recession, look at three divergent survival strategies, and then pivot to a deep dive on XPO's tech-driven turnaround to see what actually happens to their margins when the market finally recovers. Section 1, the Great Freight Recession. Look, to really understand the tactical moves these companies are making, we first have to understand the punishing environment that's squeezing the entire industry right now. The ISM Manufacturing Index has been stuck in contraction for roughly 32 of the last 35 months. I mean, think about that. This isn't just a tiny seasonal dip. This is relentless, prolonged pressure on the entire LTL market. Imagine having a massive, fixed machine, terminals, trucks, salaried employees, and watching the volume that feeds that machine continuously shrink over nearly 3 years. That is the brutal reality these operators are dealing with every single day. So, as analysts, the crucial point for our case study today is the operating ratio. If you take one thing away from this explainer, let it be this hero metric. It is simply the percentage of a company's revenue that gets eaten up by their operating expenses. For example, an operating ratio of 75% means for every dollar that comes in the door, 75 cents goes right back out to cover costs. In the LTL business, a lower operating ratio is always, always better. Section 2. Three divergent survival strategies. What's absolutely fascinating here is how the exact same macroeconomic recession has forced three fierce competitors into three completely different tactical playbooks. We've got Old Dominion Freight Line, or ODFL, playing patient defense with a world-class operating ratio. Then there's Saia, playing a high-stakes offense, intentionally running a much higher OR to expand rapidly. And XPO, they're executing a top-to-bottom tech reboot to structurally fix their margins. Let's break these down, starting with ODFL. They are the undisputed king of efficiency right now. Their 74.3% operating ratio is literally the industry gold standard. And they pull this off while delivering an astonishing 99% on-time service and a 0.1% cargo claims ratio. That means they basically never lose or break your freight. But honestly, here's the most fascinating part. They are holding over 30% in excess terminal capacity. They built the real estate, and now they are deliberately keeping a massive chunk of their network completely empty, just waiting for the market to turn. They are a fortress. Saia, conversely, is running an all-out blitz. They're taking a huge short-term hit to their margins, driving that OR up to 87.6%, because they are aggressively opening new terminals to build out a national footprint. They are absorbing massive short-term cost inflation to do this. And wow, is it a huge gamble? Not only are they paying for empty terminals today, but they also have massive regulatory risks hanging over them. Take California's zero-emission mandate, for example, which is forcing them to plan for incredibly expensive electric trucks that barely even exist at scale yet. Section 3, the engineering mindset. Let's zoom in on XPO and see how a really unique philosophy is anchoring their entire corporate transformation. XPO CEO Mario Harik is actually a former software engineer. When someone asked him how a programmer ends up running a massive trucking empire, he said, "What do engineers do? They build things and they fix things." He views corporate strategy the exact same way a coder views debugging a complex system. Harik applies this classic engineering design process directly to XPO's business. Step 1, identify the goal. Next, collect the data. Then design and test a solution. Finally, apply it to the company's key performance indicators. Instead of just trying to work harder, which is what most companies do, XPO has an engineered action plan for every single KPI they track. They're translating abstract corporate goals into strict, solvable math problems. Section 4, AI meets trucking. This highly analytical mindset birthed what they call their LTL 2.0 plan, a strategy using proprietary tech to structurally rewire the entire company. And this brilliantly illustrates the scale of AI in the real world. I mean, forget chatbots for a second. XPO's proprietary smart AI is systematically eliminating millions of dollars in deadweight costs. The algorithms have already driven a 12% reduction in empty miles, which, if you think about it, is pure wasted fuel and time. They've also reduced expensive, inefficient line haul route changes by an incredible 80%. They're even insourcing their line haul routes to their own drivers, just so they have total data control to feed back into this AI. All of this is specifically engineered to hit one massive goal: improving their operating ratio by 600 basis points by 2027. Section 5. Proof is in the profits. Because let's be real, a turnaround strategy is just a nice PowerPoint presentation until it actually shows up in the SEC filings. So let's look at the hard data for Q2 2026. In July 2026, XPO released their second quarter results, and the numbers completely defied the industry's seasonal expectations. While the rest of the market was still dragging through this nasty freight recession, XPO announced they had accelerated their performance significantly. Their adjusted diluted earnings per share rocketed from $1.05 in the second quarter of 2025 up to a massive $1.70 in Q2 of 2026. That 61.9% year-over-year jump proves the algorithms are actually doing their job, stripping out the waste so more of that revenue drops straight to the bottom line. But most importantly, they broke the psychological 80% efficiency barrier, bringing their adjusted operating ratio down to a company record of 79.9%. That is a massive 300 basis point improvement in just one single year. They're fundamentally changing the underlying cost structure of the business. And here's the best part. They achieved these soaring margins while simultaneously delivering premium quality to their customers. They cut their damage claims ratio down to a company best of less than 0.2%. Remember ODFL at 0.1%? Well, XPO has almost entirely closed that quality gap, improving their damage frequency by nearly 90% since late 2021. And we all know when you don't break things, customers actually let you raise your prices. Which brings us to our final section, Section 6, the explosive upside. As analysts, we have to ask, what exactly happens when the freight market finally recovers? Because of all this AI-driven optimization, XPO is targeting over 40% incremental margins when macroeconomic demand returns. To put that in perspective, that means for every new dollar of revenue that comes in post-recession, over 40 cents is expected to be pure profit. Why? Because all those pesky fixed costs have already been engineered away. Which leaves us with a truly fascinating reality. ODFL is sitting there holding 30% empty capacity. Saia is aggressively building out new terminals, and XPO is using AI to hit absolute record margins. So if these logistical machines are this lean and this profitable, while the economy is stuck in a 3-year rut, how explosive will their upside be when the manufacturing sector finally shifts back into high gear? It's a masterclass in operational leverage that you'll definitely want to keep an eye on. Thanks for joining me on this explainer. I hope you found this breakdown as fascinating as I did. Do your own homework, and I'll catch you next time.